How is China tackling its most severe property downturn in decades? In recent months, China's property market has witnessed a dramatic slump, with housing prices plummeting nearly 10% since the start of the year. This sector, vital to the nation's economy, influences a myriad of related industries, from construction to home furnishings. The ripple effects of this downturn are profound, affecting not just the economic figures but the livelihoods of millions. Dozens of property developers, once the architects of China's rapidly changing urban landscapes, have now defaulted on their debts. This financial instability has led to numerous construction projects stalling, leaving skeletal structures to loom unfinished over the cities. As these towering projects grind to a halt, the broader implications are stark. The property sector's struggles cast a long shadow over China's economic landscape, threatening to pull growth down with it. With the property sector in deep crisis, China's economic growth is severely threatened. In response to the escalating crisis, China has rolled out new measures to revive its property market. The People's Bank of China, in a bold move to breathe life back into the housing sector, has introduced significant adjustments to the financial requirements for home buyers. This includes a strategic reduction in the minimum down payments required for mortgages. For first homes, the down payment has been lowered to 15% of the purchase price, and for second homes, it now stands at 25%. Moreover, in an unprecedented step, the central bank has removed the floor on interest rates for both first and second home mortgages. This decision paves the way for banks to offer more competitive and potentially lower interest rates, tailored to the financial circumstances of individual borrowers. This flexibility in interest rates is expected to make mortgages more attractive and accessible to a broader segment of the population. These measures come at a critical time. China's housing market has faced a significant downturn, with prices slumping and numerous development projects stalling. The reduction in down payments is poised to lower the entry barrier for potential homeowners, especially younger families and first-time buyers who may have been previously sidelined by the high upfront costs associated with purchasing a home. The removal of interest rate floors is anticipated to inject more dynamism into the mortgage market. It allows financial institutions the leeway to set competitive rates that could lead to an increase in mortgage applications. This is particularly vital in stimulating the economy, as a revitalized housing market can have wide-reaching effects on various sectors, including construction, home furnishing, and appliances. These financial easements are designed not just to stabilize the property market, but also to restore confidence among investors and the public. By making home buying more financially feasible, the People's Bank of China aims to encourage a wave of new buyers into the market. The ultimate goal is to absorb the excess inventory that is built up due to previous overdevelopments, and to ensure that the unfinished projects across urban China are completed and inhabited. These measures aim to make housing more affordable and attract new buyers to the market. But how will these measures be implemented across China's diverse urban landscape? Vice Premier He Lifeng has emphasized the necessity of rolling out policies that are tailored to the unique needs of each city. This approach recognizes that the economic and property market conditions can vary significantly from one region to another. In bustling metropolises, the demand for housing may remain robust, while smaller cities might struggle with an oversupply of unsold homes. The central challenge lies in absorbing the existing commercial housing stock. Across many cities, there are unfinished projects and developments that have stalled, leaving potential homeowners in limbo. The focus is on ensuring that these sold but unfinished housing projects reach completion. This not only provides relief to buyers who have invested their savings, but also helps stabilize the local economy by boosting construction-related employment and spending. Moreover, these tailored policies are designed to encourage the absorption of existing commercial properties, which can help prevent further decline in property prices and avoid the creation of ghost towns. By doing so, the government aims to revive confidence in the property market, ensuring that the housing sector continues to be a cornerstone of economic stability. Flexibility in policy application could be key to addressing the unique challenges faced by different cities. What could these changes mean for China's broader economy? In the intricate tapestry of China's economy, the property sector acts much like a keystone, holding various other economic threads in place. By introducing measures to rejuvenate this sector, the ripple effects could potentially spread far beyond the confines of real estate. Firstly, consider the direct impact of reduced minimum down payments and the removal of interest rate floors. These adjustments make home buying more accessible to a wider array of consumers, potentially leading to an uptick in property sales. This initial spark in the real estate market could ignite consumer spending. As more homes are bought, the demand for home furnishings, appliances, and renovations could see a significant boost. This is not just about buying a space to live. It's about transforming that space into a home, which often involves considerable expenditure on goods and services. Moreover, the construction industry, which has been languishing due to halted projects and developer bankruptcies, might find new vigor. Restarting stalled projects and initiating new ones will likely create jobs from laborers to architects, further injecting money into the economy through wages. However, while these measures aim to stimulate growth, they come amid lingering shadows. The specter of high developer debts and a plethora of unfinished housing projects cannot be ignored. The question then arises, are these measures robust enough to counterbalance these negative trends? The effectiveness of these policies will largely depend on their implementation and the overall economic environment. If consumer confidence is bolstered and spending increases, we could see a virtuous cycle of economic activity. However, if debts continue to mount and projects remain incomplete, these measures might only offer temporary relief, akin to placing a band-aid on a deeper wound. Furthermore, it's essential to monitor how these policies influence investor sentiment. A stable and growing real estate market can attract both domestic and international investors, providing the capital necessary to sustain long-term growth. In conclusion, while the path forward is fraught with challenges, the strategic revitalization of the property market could indeed be a linchpin for broader economic recovery. A revived property market could be a linchpin for broader economic recovery. China's property woes are not occurring in isolation. Around the globe, real estate markets are showing signs of strain, with the United States being a notable example. Recently, the Conference Board's leading indicators index in the U.S. declined by 0.6% in April, following a drop of 0.3% in March. This trend signals potential softening in the U.S. economy, mirroring some of the challenges faced by China. The decline in the U.S. is fueled by factors like a negative yield spread and a drop in new building permits, which echo the broader global anxieties about real estate markets. Both countries are grappling with the repercussions of high interest rates and the lingering effects of the pandemic, which have dampened consumer confidence and investment. In China, the government's intervention to stabilize the property market reflects a strategic response, not unlike measures that might be considered elsewhere. As the world's second-largest economy tries to spur growth by supporting its property sector, it's clear that the outcomes will resonate beyond its borders. The interconnections in global markets mean that China's property market struggles have wider implications. As China introduces bold measures to combat its property market downturn, the world watches closely. The unfolding scenario reflects a strategic recalibration as Beijing deploys a series of initiatives aimed at revitalizing a flagging sector that has profound implications for its broader economic landscape. To recap, the Chinese government has slashed the minimum down payment for mortgages and abolished the floor on interest rates for first and second homes. This move is designed to make home ownership more accessible and stimulate demand within the property sector. Furthermore, the reduction in interest rates for Housing Provident Fund loans marks a direct attempt to ease financial burdens and encourage prospective buyers to step into the market. The localized approach, tailoring policies to the specific needs of different cities, underscores a nuanced strategy, recognizing that the one-size-fits-all method is less effective in a country as vast and diverse as China. The emphasis on ensuring the delivery of already promised housing projects aims to rebuild trust and security in the property market. However, these measures are not without risks. The potential for stimulating demand too quickly could lead to a superficial recovery, masking underlying structural issues that need addressing. Conversely, if these initiatives fail to ignite sufficient interest and confidence among consumers and investors, the property market could experience further declines, dragging down related industries and, by extension, the broader economy. Looking ahead, the effectiveness of these measures will largely depend on broader economic conditions, both domestically and globally. The global economic environment remains uncertain, with factors such as inflation rates, supply chain disruptions, and geopolitical tensions playing significant roles. If external economic pressures remain high, they could dampen the effectiveness of China's policy adjustments. Moreover, the psychological impact on potential homebuyers, who may prefer to wait for clearer signs of market stabilization, cannot be underestimated. The success of these interventions will hinge on the government's ability to maintain a delicate balance between encouraging immediate economic engagement and sustaining long-term market health. Only time will tell if these measures will be enough to stem the tide of China's property market crisis and restore confidence in its economy.